Hello for everyone who is joining. We'll give it another minute for other attendees to join the webinar. Thank you for your patience. All right, so it's time. Good evening and afternoon to everyone joining today. Thank you for tuning in for our panel discussion on financing and commercializing sustainable technologies. I am Karen Ng, a first-year master's student at UPenn, working for the Wharton Risk Center on climate change programming. This event is hosted by Wharton Risk Center and the Kleinman Center for Energy Policy as part of the Wharton Planet Week, which is organized by Sustainable Business Coalition. And we strongly encourage you to check out other great events taking place this week on the Planet Week website. A few housekeeping notes. We're recording today's panel session. If you have any questions to the panelists, please put them into the Q&A box. Please also feel free to introduce yourself to other attendees in the chat box. And with that, I am pleased to turn it over to our moderator today, Professor Peter Sarris from the Kleinman Center for Energy Policy. Professor, the floor is yours.
Thanks so much, Karen, and welcome to everyone. My name is Pete Sarris. I'm a research assistant professor here at Penn in chemical and biomolecular engineering and energy policy. I serve as interim director of the Clean Energy Conversions Laboratory. This lab was the creation of Jennifer Wilcox, who is currently on leave as the Principal Deputy Assistant Secretary of Fossil Energy and Carbon Management at the Department of Energy. Our research is focused on minimizing the environmental and climate impacts of our dependence on fossil fuels. This involves techno-economic and life cycle assessments, carbon capture, utilization, and storage, and carbon dioxide removal systems, specifically in identifying regional opportunities for deployment. I'm also associate editor for the International Journal of Greenhouse Gas Control and a judge on the Carbon Removal X Prize sponsored by the Musk Foundation. And so this is why we're here today. We find ourselves in a state of climate emergency. To avoid the worst effects of climate change, it is essential to facilitate the speed of scaling climate technologies such as alternative energy sources, digital solutions for optimization, smart and low carbon mobility, waste management, CCUS, and many others. For the next hour, we'll explore critical questions that address the challenges and opportunities ahead. Let me start though by introducing our panel of industry experts. We have James Wagstaff, a Wharton alumni, who serves as the Senior Vice President of Global Growth at Wood Mackenzie. We have Mark Tomasovic, who is the Principal of Incentivize Ventures. And we also have Suzanne Hunt, the Policy Director at Generate Capital. Thank you all for joining us today. And perhaps to familiarize our audience with your company and yourselves, would you mind telling us a little bit about what your company does, your role, and your background? Let's start with Suzanne.
Sure, thanks so much for having me. As Peter said, I'm Policy Director for Generate Capital. And to your point about deploying these solutions at scale, the founders of Generate about 8 years ago started the company basically because we are not deploying climate solutions at the speed and scale necessary to address the climate crisis. So they looked at sort of the financial ecosystem that's funding this space, and you've got lots of interest in energy in the VC space, the early stage innovation space. There's lots of institutional investors that will finance huge kind of old school energy infrastructure. But there's this huge need for project finance to actually finance everything from electric bus fleets to organic waste recycling to community solar to batteries to hydrogen fuel cells to the entire kind of ecosystem of efficiency and renewables and other climate solutions. So 8 years in, we're at several hundred staff, and the team is growing really fast. And I think we're at about 10 billion in balance sheet capacity. Oh, and one other thing, we are a public benefit corporation, which I think is hopefully interesting for students as well.
Wonderful. Thank you, Suzanne. James, how about you?
Sure. Thank you. And pleasure to be here. As the professor mentioned, I'm James Wagstaff, a senior vice president with Wood Mackenzie. Wood Mackenzie is a global research, data, and consultancy based out of the UK, but we're a global company. We focus on helping corporations and governments around the world make better commercial decisions. And our business is organized into research teams that are focused on oil and gas and LNG, power and renewables, chemicals, and metals and mining. So we cover really the full value chain in the energy industry. The company actually began, for those who aren't familiar, as a stockbroker in Edinburgh in the 1920s, but ultimately differentiated itself by reporting on an annual sort of state of the oil markets, where it built a reputation for having quality equity research, but again, with a focus on oil market reports. And in the 70s became a real leader in thinking about oil prices and how, again, companies and governments should think about their role in the energy industry. And in the last 50 years, the company's really diversified its research and data capabilities throughout the energy value chain. So today we have 1,500 employees in 30 different countries with 700 different sector-focused analysts and about 3,000 customers. So really large scale in our conversations with corporations and NGOs as well. And then I think just by way of background for myself, I began in the trading side of the energy business, working on commodity transactions for natural gas, electricity, and environmental commodities like emissions reductions, renewable energy credits, et cetera. And then I went from that organization into a supply chain cost management company, which was ultimately acquired by Wood Mackenzie. And I've been with the company for about 10 years.
Great. Thanks, James. Finally, Mark.
Yeah, thanks, Peter. I'm Mark Tomasovic. I'm a principal here at Energize Ventures. And at Energize, we invest in the software layer for climate and infrastructure. And so what does that mean? Well, if it is a software product and it's servicing an analog industry like construction or manufacturing or the deployment of renewables or telecom even, or transmission, well, we invest at that intersection. So we've got about 750 million in AUM. We can invest Series A through really pre-IPO. Check size can be as small as 8 million up to as large as 50 million. And what's unique about us is actually about a third of our capital comes from strategics within the industry. So while we're not strategic or a financial first venture capital firm, about a third of our capital comes from big corporates that are renewables, utilities, manufacturing companies, for instance, oil and gas firms looking to play the energy transition. And so the strategics provide a really good insight to help us craft our thesis internally. And then likewise, we can provide them insights into A, how to make their organizations more digital, and then B, how to make their organizations more sustainable. So I'm a principal at the fund. My background's actually in the oil and gas industry. And then I went and got my MBA and did a quick stint in private equity. And I've been with Energize for a little over 2 years now.
Terrific. Thanks, Mark. Thanks, James, Suzanne. Thank you all for being here and for those introductions. So let's get right into it. We know that these technologies will be important, but what are they? What energy technologies do you think are impactful for reaching net zero, but are currently underinvested? James, maybe we'll start with you.
Sure. I think sort of my vantage point on the question, it comes from how companies even start to begin to measure net zero. So a lot of organizations have announced objectives toward reaching emissions reductions or ultimately net zero goals by certain deadlines. But when you think about, for a large organization or a global organization, the effort and even understanding how to get from the current state down to zero is quite a bit of tough work, and there's not a lot of great data on on emissions today for the different scopes that need to be evaluated. So the first phase of answering that question is, across a business's scope 1, 2, and 3 emissions, where are the different sources? And what are the strategies for each of those different sources? So if you think about a traditional utility, for instance, it's pretty obvious that generating electricity through the burning of fossil fuels is a scope 1 activity. And many utilities have integrated resource plans that span many years where they're starting to chart that trajectory. And so they have every utility has kind of their own different mix of assets they can pursue, from traditional sort of wind and solar assets to newer technologies, carbon reduction, carbon capture, underground storage. Offshore wind is getting a lot of traction in the US. And then you sort of follow that same methodology down each of the different scopes. To the question of where is there underinvestment, or maybe historical underinvestment, we see a lot of activity in scope 3, because for many, many years, companies didn't scrutinize scope 3 to the same extent they're being asked to scrutinize scope 3 today, and frankly report on it to investors today. So there are, ranging from analytics organizations to sensor technology to just better data assets, companies are investing in trying to build those out so they can start to treat scope 3 emissions with the same level of integrity that they are with scope 1 emissions management.
Great. How about Mark?
Yeah, I think, frankly, I mean, I think the software category in this space is really underinvested. Whether that's software to help you deploy solar panels, or whether that's software to help you trade voluntary carbon credits, or software to help you control batteries at, whether it's a wind site, or even, better understand a EV car's battery. The software layer historically has not been a real issue with the deployment of renewable energy. Historically, it's actually been the hard costs. So the cost of the hardware themselves, the solar panels themselves, the wind turbines themselves. But what's actually happened over the last decade is the cost of solar, the hard costs, have declined in cost by 90%. The cost of wind and batteries have declined in cost by 70%. And so what's left is this soft cost, the engineering, procurement, finance, and accounting that are required to deploy these renewable energy assets at scale. And those soft costs can be automated via software. And I still think there's a lot of investors out there that either think, the solar market is too small, or for instance, there's not enough assets out there to really deploy battery software at scale, or EVs haven't really penetrated the market. I think a lot of that, having lived it, I think is wrong. And I think, frankly, you can now build big software businesses in these categories like we haven't been able to do before. So I would just say anything that's, minimizing the soft costs in these industries, primarily software, has been overlooked and is starting to pick up steam, but I think is still underinvested.
Yeah, and so where Generate comes in, and it is to finance those big ticket items, the actual physical infrastructure where you need large scale patient capital. And to your question about which technologies specifically are underinvested, I think there are thousands of technologies that we need to deploy that aren't getting enough attention right now, that are mature and ready to deploy and haven't really been the apple of the eye of the financial community. So, everyone's excited about the sexy stuff like the solar, the EVs, the wind turbines. But what about the waste sector? I mean, the waste sector creates huge emissions of methane and some of the other short-lived climate pollutants that the IPCC is trying to focus our attention on. Diverting food waste from landfills, for example, is something that Generate invests in, and we finance anaerobic digesters to basically capture that methane that would have been emitted into the atmosphere and use it to displace fossil fuels for heat and power. and sometimes transport fuels. I think, often we forget that we have a ton of heavy machinery, we have a ton of infrastructure that in this messy transition that we're gonna go through over the next couple of decades is still gonna be there for years, maybe decades. Airplanes is a perfect example. What are we gonna do in those sectors? So I think there's just a huge amount to do across all of these different heat, transport, energy, agriculture, all of these different sectors. And then also taking our extractive economy and turning it into a circular economy. There's all kinds of investments in materials and logistics, and yes, I'll have to admit, Mark, we need software for the soft costs, but I am proud that Generate is actually financing and building, owning, operating the infrastructure and helping to rebuild all this massive infrastructure that's going to take sort of an all hands on deck effort over the coming decade.
Thanks, Suzanne. And James, you had mentioned scope 3, and I think that we're seeing that that's sort of forcing maybe attention into some of these overlooked sectors. Question from the audience: how do you incentivize companies to make scope 1, 2, 3 emissions reduction a priority without hard regulation, and that may not even be implementable due to a lack of technology?
It's a really good question. So that's without hard regulation. So obviously that's the first path would be regulation. And that's been the case in some jurisdictions. The second common path is through investors, and through ESG related investor and funds. Companies are investors are requiring disclosure of scope 1, 2, and 3, which isn't necessarily new, but the consistency with which corporates are hearing that from investors is newer. To the point around how do you incentivize maybe better activity in that area for corporations, one of the challenges, if you ask an oil company right now or any energy company in that reporting of emissions, is that there are lots of different standards. There's the classic is the UN science-based targets methodology, but lots of different investors can bring whatever standards they want. And so if you have one large institutional who says we would require, this level of granularity, for instance, on scope 3, and then a different investor has a different point of view on that, it can be a challenge for a company to number one, to answer those questions, but number two is it's less powerful for the investor to compare company to company. So I think more consistent standards in what investors or regulators or just stakeholders in general are asking of energy companies would allow people to better compare themselves to their peers, and then outliers would be sort of made to act on overages compared to their peer base.
Yeah, and I would just add in customer demand as well. Whether it's institutional customers or individual customers, that's a huge part of this. And then, collaborations is essential. So I mean, by definition, scope 3 emissions are out of your control. And so with one of my other hats, I have a winery in my family. I have a family business, and scope 3 emissions are a big part of the impact of that industry. And one of the big sources is glass bottles. And we have, a winemaker has no control over the climate impact of glass, but if there's collaboration among some of the efforts in Europe with some of the government agencies, with some of the buyers, and then it has to go back to the customer. So there's going to be an unprecedented need for collaboration. So all of you students, make sure you're developing your collaborative skills, not just your financial skills, because that's going to be key to all this.
Great, thanks, Suzanne. Well, a question that comes up often is who's going to pay, right? We've talked about the technologies that could be needed and the infrastructure. Where will all this new capital come from? Additionally, what sectors and capital providers, how do you pair those with projects and technologies based on capital intensity or risk reward profile, other means? Mark, maybe we'll start with you.
Yeah, I think it depends on what's being invested in. I think what's really important in the climate tech space in general is matching the company to the model of the fund that should be investing in it. So for some of the like Energize, for instance, couldn't invest in a wind turbine just because it's a longer term project, it's more capital intensive, and the return profile of that project doesn't make sense with the way that our fund is structured. We're a 10-year fund. We have 5 years to make investments and then 5 years to harvest those investments. And so venture capital is, which is one of the reasons why we focus on software investments. Venture capital makes a lot of sense for software. And there should be different funding types depending on the type of climate tech that you're funding. And so, yeah, I think it depends on the project type, and whether you use venture capital or infrastructure funding, or then you can even get further into details whether you use debt or equity. We make minority stake equity investments, in high growth companies that are trying to 3 to 5x our return in 5 years. And so typically what that means is we look for software type high gross margin profiles.
Hey, Suzanne?
Yeah, so at Generate, we raise our funding from sovereign wealth funds and pension funds, and really patient capital. So we're not raising funds that are time limited. So we can own an asset for its full lifetime. We don't have to exit in 5 years or 10 years. So that's kind of part of what is one of the things that allows us to invest in some of these long-term infrastructure assets like community solar assets and other large infrastructure.
Thanks, Mark. Or James.
Yeah, sorry, no problem. Yeah, I think that the capital is going to come. Well, it is coming from, in large part, the government right now. In particular, the DOE has a $30 to $40 billion loan program where they're trying to get capital into the hands of technology and startups that have promising technology. So government has a very big role to play in getting capital into the hands of new technology ventures. And then corporations have a very significant role, larger role to play, frankly. And it's the case that the percentage of CapEx that large natural resources organizations are spending on renewable related or carbon reducing investments is significantly more than before. And it's in the headlines very commonly. If you look at any sort of legacy or incumbent oil producer like an Exxon or a Chevron or a BP, they have dramatically shifted their investing framework from one that thinks about providing energy as the primary mechanism to one that balances providing energy with emissions objectives as well. So just a brief example from I think it was last week, Exxon reorganized its business, right? One of the behemoth in the oil industry has a new board, and they've reorganized the entire business into 3 different business lines. And one of the business lines is low and no carbon assets, which is a major milestone for the industry, but also obviously for Exxon. And so that's going to include a significant, tens of billions of capital that Exxon will need to spend through that business line in technologies that don't yet exist, certainly at the scale that Exxon would like to deploy them. They're used to projects that have, a 3 to 5 year construction timeline and cost billions of dollars, which you can't really spend that money in an environmental project right now. Offshore wind, certainly, but in terms of the range of technologies we're talking about, there aren't that many opportunities to pick from. So not only do they need to identify not only do they need to fund the project, they have to identify what the portfolio opportunities looks like for that business line. And that's just Exxon. There's hundreds of examples of companies that all over the world that are seeking to do different things, who are seeking to do the same thing. So a lot of the capital is going to come from corporates and incumbent energy companies, and then a very significant portion will come from the government as well.
Yeah, and I would just throw in that the government's are really good at certain things, and the private sector is really good at certain things. The government's really helpful in de-risking some of the private investment with loan guarantees and that kind of tool. They're really good at funding the early stage R&D that private sector won't fund often. They're the only entity out there that will crack down and regulate, for example, the outrageous leakage of methane from some of the oil and gas infrastructure in the world. So there's a really important role there for the government, but the vast majority of the capital out there and the folks that are going to move really fast and deploy at the speed we need is the private sector. So we really need the governments of the world and private sector collaborating effectively. And we need the governments to be putting policies in place that get the incentives right. Because right now we have incentives that are not always pointing us in the most climate friendly direction. So that's one of the priorities right now.
Yeah, and I would just add, usually government grants are non-dilutive. So if you're starting a tech startup and, in the climate space and you don't want to give away 20% of your company, before you even have a product, government grants are a good way to go about that. Because the worst case scenario is you give away too much of your company to VC investors, right? So yeah, government funding is a really good way to get non-dilutive funding.
Yeah, and I'll maybe echo Suzanne's point, which I think was a really valid one. It's almost like there's different investment targets as well. So the loan the government can provide can really maybe has a wider breadth of technologies it's able to fund versus a corporate really has tighter parameters. They need something that's going to scale quickly within their business. It's going to contribute to their current mix of assets, and it's going to generate returns at the standards they require. So it's a very different investment criteria set, and there's the roles they play are probably more complementary than anything.
Thanks, James. Yeah, there's a question in the chat, but I think you all just addressed it very nicely in terms of the best use of government versus private money. We are seeing a lot in terms of at least recently. I think there wasn't quite the demand pull, at least in the carbon space, and now suddenly we have seen this tremendous demand is driven by companies like Microsoft and Shopify and their scope 3, and so we're seeing this tremendous willingness to pay. Are you all also seeing this in terms of technologies, or they're riding this sort of wave of the 20th of this next century as we stare down carbon reductions and getting to scale?
I want to let the other guys jump in before I dive in, if you want to jump in, Mark.
I can take that. So when we look at voluntary carbon markets, and we look at these tech firms like Microsoft and Amazon and Walmart, they're paying serious money for voluntary carbon credits to offset their emissions and to go net zero by, call it 2030 or whatever their target is. So we're actually seeing significant increase in the voluntary carbon markets. And so what that's enabling is a lot of tech startups that can go out and plant trees or plug abandoned oil wells or prevent the harvesting of trees to generate credits and then sell those credits through a marketplace to some of these voluntary buyers. So I think willingness to pay is increasing. And then, even like in terms of the solar industry, I also think a lot of, folks are becoming more open to having solar panels on their rooftops at home. Willingness to pay for, broadly for folks that are interested in adopting climate tech, I think is increasing. And then I think at the consumer level, people want to buy green brands, people want to buy sustainable brands. And I think this is the first time that we're seeing it. And I think it is an inflection that's quite frankly only happened in the last couple of years.
Yeah, no, I agree that the demand, these corporate net zero commitments have really helped, and they've created real interest in some cases real money. But I would also, just as a counterpoint, just put a word of caution out that there is quite a bit of skepticism. There are offsets that are high quality, and there are plenty of offsets that are very low quality. It's paramount that we directly reduce emissions rapidly right away. And so where that's not possible, there are some emissions that are unavoidable. Offsets are a useful tool, but they shouldn't be emphasized over other more absolute concrete reductions.
Yeah. I'm sorry, James, go ahead.
Oh, sure. I was going to make a similar comment, which is the offsets are a part of the pie, but not necessarily the answer. Certainly in instances where, like you mentioned, I think Amazon and Microsoft, where they're trying to offset energy demand at a data center, it's not really a core competency for them to develop and own wind farms or solar panels. They do in many instances, or they contract directly, but it's probably not in the calculus for the primary business objective. So in that environment, offsets can play a really important role, and to the extent that the quality is managed and they understand exactly what they're buying. But for organizations who are in the business of building and operating energy assets, I think investors want to see more than just spending money on it. Also, they want to see action with the current, among the current kind of asset base that is emitting carbon.
Yeah, and I would also encourage students to really look when companies are making commitments. We really have to push them and make sure that they're honoring them, and also look at what industry groups are they funding? Are they funding efforts and commercials and all kinds of work to undermine climate policy or to prevent there's a lot going on that we all need to have our very critical hats on as we look at some of these commitments and some of what the right hand is doing and the left hand is doing with some of these big actors. And I think, James, we were talking the other day about how depending on how you slice and dice global climate impact, there are something like 70 huge corporates that are responsible for 100%, or excuse me, what is it? What did we decide? 100 big corporates that are responsible for something like 70% of climate pollution. So I just want to say, it's great. All this activity is great, but big picture, we have to keep pushing them harder and faster.
Thanks, Suzanne. Indeed, we have to keep an eye on them. And a number that will be emerging, right, over in response to this, and to, of course, nobly meet the climate challenge. Who is moving to the sustainable technology space today? And what are the incentives or factors that drive or hamper the financing and the uptake of these technologies? Suzanne, we'll go right back to you.
Oh, things that hamper the uptake. Gosh, there's, I'll touch on a few and then hand it off to Mark and James. Inertia is, it change is hard. So there's just a lot of inertia in a lot of industries. But often, access to capital, either not wanting to dilute, as Mark was talking about earlier, or just not wanting to further leverage your business. And so that's why offering infrastructure as a service is one of the things that's been really successful with Generate. Providing the capital, so the upfront, and offering, we were, I think, the first company to offer an electric bus leasing option for companies and universities and that kind of thing. So I think, getting over that upfront capital barrier is really important. I think there's certainly information barriers. There's a lot of, it takes a lot of effort to go outside of your core competency, as James was talking about. If winemaking is your core competency, or making widgets is your core competency, and suddenly you have to become an expert in systems controls and renewable energy technologies and and offsets and all these other things. There's a big information barrier there too.
Suzanne, how about James?
Sure. Sorry, I was already off mute. So I think many more people are getting into sustainable energy and technologies than previously. Certainly, every energy company has to have a strategy that they're publicly sort of required to share with investors at this point. I think the incentives for that are, again, investors are requiring it by and large at a rate they haven't historically, but also there's a more practical sort of incentive, which is just the risk of managing an aging asset base. So there's lots of stories about old pipelines, old oil rigs leaking, having environmental problems. And the backlash for that is significant. I mean, there's tremendous penalties. Obviously, the environmental damage is expensive to clean up. And so just from kind of a brass tacks point of view, there is a financial risk to not adapting aging technologies in a more sustainable fashion. And so when you think about this is very common today, if you're a pipeline operator in North America, you need to evaluate and quantify the permitting risk for getting the pipeline done. It's just because it's going to have a financial return when the oil or the gas flows through it, doesn't mean that's actually going to be realized because of all the hurdles that need to be overcome in getting that project completed. And so what a lot of natural gas companies are doing is thinking about how they can have more renewable natural gas, right? Aside from maybe the sources that they're getting gas from, who are the buyers of the gas, and what's the methodology for getting the gas to market. So in all the kind of investment choices that large corporates in the energy space need to make, it's the equation for sort of a traditional asset versus a more sustainable asset isn't what it used to be. People really need to value, or are valuing, sustainable investments sort of more competitively than they have in the past.
Yeah, and I would add there, I think climate is becoming its own asset class. And what I mean by that is, if I'm a limited partner, if I'm an endowment, or if I'm a pension fund, I'm starting to allocate a certain percentage of my portfolio to climate. And so what that means is now I'm starting to look at, VC funds that invest in climate and trying to figure out whether or not they fit into the climate box so that I can put them in my, certain percentage of allocation. I think, yeah, I completely agree with James. It's a cost of capital thing. Like, you have to have a sustainable strategy now to lower your cost of capital. Otherwise, it's the major financial institutions of the world just won't want to fund you, or they're divesting from assets that are too carbon intensive. I would say it does feel like there's a lot more competition in the space. So Energize was founded in 2016. So we like to say we were doing, climate software before it was cool. Now it feels like everybody has a climate fund. Some people are doing it out of, their crypto fund. Some people are doing it out of their bio fund. Everybody's doing it a little bit differently. What I think there still is a lack of, though, is a lot of those other VC firms that are investing in climate tech are still investing in the very early stage, the seed stage, maybe the early Series A. I still think there's a lack of growth equity in climate tech broadly. And I'm primarily here talking about like digital solutions, whether that's software or even like robotics or things of that nature. And I think what was really interesting is last year, we saw SPACs take a step to fill that growth capital stage. So instead of a company traditionally going Series A, Series, seed A, B, C, D, et cetera, and then eventually IPO, a lot of what the climate tech companies did was they went Series Seed, A, maybe B, and then straight to the public markets via SPAC, because there's still this lack of growth equity in the climate tech space. And so I think while everybody's starting a climate tech fund and LPs are trying to get allocation into climate tech, a lot of that is still at the very, very early stages. And so I think there's still opportunity in the growth equity space.
Oh, good job, us. We went 40 minutes without mentioning SPACs.
I know, I had to bring it up.
I think that means you buy drinks when we see each other. We all see each other next. No, I think that's right. And I mean, Generate Capital provides some growth equity as well. So we actually, we do project finance, but we also do corporate finance as well, because there is this just a really big need out there. I agree. And I think PricewaterhouseCoopers numbers show that 14 cents out of every VC dollar right now is going to climate tech. So yeah, it's getting big.
Hey, Suzanne, yeah, we're seeing some technologies getting a lot of attention, like hydrogen's other ignored. You brought up specifically the idea of doing deep reductions now, removals later. So on that, are you worried that any investment and a lot of the driven investment today could be distracting?
The driven investment, did you say?
Yeah. The investment we're seeing that's being driven by a number of, like, for example, the scope 3, the corporate pledges, the attention to the technologies. Do you feel that we have the right order of operation, so to speak?
I mean, this is where I think, you know, often, especially in settings where we're you know, having these intellectual conversations, we tend to think that we're going to actually do this right, and it's going to be this nice, tidy energy transition. And in reality, it's a messy world. And this is, yeah, some money is going to be wasted here, and certain things aren't going to be done well there. And so, I mean, that's the challenge: is you try to get the very best information, you work with the best partners, you hire the top talent, and you use the best metrics, as James was talking about, and you do your best to hit like the most urgent opportunities as fast as you can, and do it right. So that's the balancing act. But yeah, I mean, this is not going to be neat and tidy. There's definitely going to be some wasted money here and there. I mean, we've seen it in renewable fuels, in the renewable fuel space. There's a lot of dead bodies along that road, and investors get smarter, and people, information gets better, and you learn from the mistakes. And so yeah, I don't know if you guys want to jump in on that one.
Yeah, I can just go real quick. I think it's just important to match the model of the fund to the type of technology that you're investing in. So like, we looked at a company, super cool company, definitely would change the outlook of the world, but they weren't expected to generate revenue until like 2030. And so we're expected to essentially return our fund by then, because it's a 2021 vintage fund. And so it doesn't make sense for our fund in particular. They needed longer term capital, and so I think there will be some times where people kind of mix up the fund structure with what they're investing in, and mix up the time horizon of the fund with the time horizon of the potential investment. I think that's where things can get kind of messy. But yeah, I mean, broadly, I think just more money is better in this space. Ultimately, more money is better for the world. More money is better for entrepreneurs in the space. And so I think everybody needs to approach it. Everybody's trying to approach it in slightly different ways, but I think any way is a good way.
I mean, I think you can also just look at where the smart money's going. I think you can look at how well companies like Generate are performing for their investors. I think you can look at, what some of the biggest advisors and the BlackRocks of the world are saying, and see that this, this is, the smart place to put money. So I think just on a high level, I just want to make sure we make that point.
Yeah, and maybe to add to that point, it's on the one hand, the market isn't really giving a flyer to companies for just participating in the energy transition. In other words, there's still an expectation that returns are going to be as good as expected. So again, to use the analogy of some of the legacy oil companies, Wall Street has an expectation of what those projects can return, 20% IRRs or more for a big offshore rig project. And what happens when those companies say, well, we aren't going to invest any longer in offshore oil, we're going to invest in offshore wind, but the rates of return on offshore wind are half of what they are for oil, presuming again that the price of oil remains high. So it's to the question around kind of, is the order of operations correct? It's the broader macro picture has a lot to do with it, because if the price of oil continues to tick up and persists at near $100, how do people respond to that who are expecting strong returns from oil companies who have shifted capital away from oil projects and into renewables projects? So I think people, certainly a lot of management teams are taking the long view, which is appropriate and I think correct. But in the short term, there's going to be a lot of turbulence around the price of oil effectively, because that becomes the benchmark for how these companies are performing.
Well, and this is where pricing externalities comes in, and this is where governance comes in, and this is where, one of the strategies to deal with this is to find kind of novel, maybe niche use cases for some of these technologies, prove out the use case, scale the technology, benefit from all of that deployment-led innovation, drive the costs down, and then expand. So it's no longer niche. You're seeing that with things like hydrogen fuel cell forklifts in warehouses, where it made perfect sense in that niche application, and now that company, those markets are growing. So I think, yes, to the timing issue, we've got to keep pushing governments to better monetize, incorporate externalities into these financial equations.
I appreciate the discussion so far. Thank you all. Maybe we'll jump to some of our Q&A from the audience as we wrap up here. I've got two. Do you have any advice for scientists, engineers working more on the R&D side? To look for jobs moving into the investing financial side. Likewise, where would you recommend startups, perhaps revenue making 10 years away, for example? Where should they be looking for capital? Open it up to the floor.
That's you, Mark.
Yeah, I can go there. So I'm a chemical engineer. I worked in oil and gas. I worked kind of across the full value chain out in the field. Whether it was upstream and then for a stint in midstream, and then actually worked in downstream chemicals. And what I realized when I wanted to make the switch to investing, I wanted to do it in a very low risk way. So I thought the best way to do it would be to go to business school and then figure out, is this even something I really want to do, first of all. So I thought business school was the most low risk kind of pivot into the industry. And then once I was in business school, I really doubled down on my energy background, because frankly, I don't think I could have made the jump to a generalist investing firm or a CPG investing firm or something that I didn't have the industry expertise in. But the investing firms, fortunately, looked at me and saw, okay, this individual has the field expertise. If we're evaluating a drone software company that can mitigate methane emissions across pipelines, well, I can say, hey, I've worked in the pipeline industry. Companies would either yes adopt this or B no not adopt it. And so what I really did was like really doubled down on the industry expertise, really got my pitch honed in that category, and then just took like as many finance classes as I could, took as many as those Wall Street prep and training the street classes as I could, and got really good on like the financial modeling side of things. And then when I went to these companies, I kind of had the whole pitch. Some of them still wanted more finance experience, but I could really sell, especially to VC, which cares more about engineering and more about technology. I could really sell the field engineering background. I'll just quickly comment on the second question. Startups that are longer term, more breakthrough technologies that are going to generate revenue in 10 years. Fortunately, we're seeing funds be established to fund those technologies. So there's some really good ones here in the Northeast that have 20-year fund lives. Breakthrough Energy, the Engine. There's some really good funds that are being established to invest in these moonshot ideas that are very patient capital, and that can help you through those R&D stages and really get you to commercialization, whether that's 10 years or 15 years. It doesn't matter for them because that's how their fund is set up.
I would just add to the question about prep for our folks that want to be on the innovation R&D side of things. I would urge folks to get some real world experience in the industries and sectors you want to work in. There's nothing more frustrating than seeing a pitch deck for a technology that's had a huge amount of like engineering and technological like just muscle thrown at it, and it's solving the wrong question, or it like forgets about real world conditions where that would make this technology completely impractical and unworkable. So I would just really urge folks to get real world experience before going, in addition to the hardcore R&D work.
I think you guys nailed it. I have nothing to add.
Great advice all around. I'm sure they appreciate it. Maybe a final question as we start to wrap up here. Well, we had the clean tech 1.0 burst in the 2000s with a few survivors. We're betting on clean tech again. How is this different? Will it last? And what are the lessons we can learn from the first time around?
Should I answer that first?
Yeah, sure.
Okay. Yeah, it's an interesting question in the sense that a lot of the things we're seeing today happened before. So there was a question about, or a comment about, companies investing in emissions reduction credits, carbon offsets, et cetera. There was a huge market for that in 2007, 2008, where a lot of Fortune 500 companies were spending a lot of money on offsetting their the emissions from their operations. They were buying RECs all over the place. There was, Kyoto, the Kyoto Protocol was in place, and people were buying required. That was a required market for offset. So these markets have been around. They were subject to the financial downturn, and a lot of them evaporated in 2009. So a lot of the lessons from clean tech sort of 1.0 is that when companies are investing for the sake of, well, I guess the lesson is, what's the intent behind the company's involvement in those markets? Is it largely checking the box to demonstrate goodwill and signal sort of a behavior they want their stakeholders to perceive around how the business is run? Or is there a broader, longer run intent behind those activities? And I think the difference this time is that there's a lot more structure and more stakeholders involved in the same activities. So companies that are going out and spending a lot of money on offsets or RECs are doing so because they have a longer run plan around how that fits into a bigger emissions management program, a bigger CSR. Again, a lot of it in the first wave was companies just doing that because it was a nice thing to do and their peers were doing it, so they didn't want to be left behind. But now it's really sort of fundamental to a strategy, which hopefully means it's longer lasting and has and is a better foundation for an ecosystem of clean tech and sustainable outcomes. So, but it's an important lesson to bring with you, because I think for students and companies that are sort of just getting started in the space, it's really important to have a strong foundation in what your customers are pursuing and why the product or the credit or whatever it is a good fit with that bigger plan.
Yeah, I think what I would add there is the hardware itself has just gotten cheaper in the last decade. Like solar is now, the levelized cost of solar, the subsidized levelized cost of solar is now competitive with coal-fired generation. And so sorry, what was that, Suzanne?
The fossil fuels are also subsidized. Just want to.
Yeah, fair. Especially exploration there. But yeah, I would just say the cost curves have declined, and it's enabled so much more, whether that's software or deploying, solar or wind at scale. That's just something that's changed in the last decade.
Yeah, I mean, this is just such a good time to get involved in climate tech. I mean, I'm not that old, but when, I would say, like, in the early days of my involvement in the industry, I mean, it was still this attitude of, solar, the solar guys are here, pat them on the head. Isn't that cute? That'll never be like big energy. And that is, no one has to deal with that anymore. Like that is, it is just like the sky's the limit right now for these industries. So it is just such a good time to get involved.
Great. Great parting thoughts to our audience. I want to once again thank all of our panelists for very lively discussion today. Thank you all for listening. We need all the human capital we can get to solve this climate problem. The panelists have left their contact information in the chat. So if you didn't get your question answered, they're offering to talk later. So again, thank you all. I'll pass it back over to Karen.
And thank you, Peter. I'm sorry we didn't talk about carbon sequestration, so we'll have to do another webinar.
It's okay. We'll get there.
Absolutely. Thank you again for everyone for joining this panel, and we'll wrap it up right here. Please check out other great events at Planet Week. Thank you all so much.